In this recording, we're going to look at question 2 in your question pack 8, focused on an individual company statement of cash flows. So again, this should be a revision focused on IAS 7, preparation of statement of cash flows. And it's kind of a stepping stone onto consolidated cash flows, because if you can do an individual cash flow, then you're just adding on a couple of complexities around NCI, associates, and acquisitions or disposal of subsidiaries. So we'll focus on getting the individual cash flows correct first. So you can see down here, you're asked to prepare a statement of cash flows for the year end 31st December 2014, and you're told here do both methods, direct and indirect. So we'll do that as we go along. The first thing you'll do now, my advice always is the first page of your answer for a statement of cash flows is set out a template for the answer. So template looks like this. Statement of cash flows is set into 3 sections: operating activities, investing, and financing. We're going to do operating activities as a single working, because it's either going to be the direct method or the indirect. We'll show you those in working 2, working 3. And then we're going to do the investing. So as we spot something else as we go through the question, you slot them in. I'll leave a couple of extra spare lines there that as you find something, put it in, because you're getting marks as you go along. And one of the key disclosure requirements in IAS 7 is you must do this at the end. What's the net increase or decrease in cash and cash equivalents? And then reconcile opening and closing balances. And we'll deal with that as well. Right, so that's always your starting point. Set out a template. Your next starting point then, working 1, is always calculate the answer. Right, what is the movement? Unusual compared to preparing a P&L and balance sheet, you actually know the answer before you start here, because we're looking at what's the movement in cash and cash equivalents from 2013 to 2014. And if we look at cash, or we look at bank, and we look at overdraft, because remember an overdraft is a cash equivalent as well, and we look for 2014 and 2013. So let's put those as text. So in 2013, in your bank and cash, you had 300, and in 2014, you had 610. So they're given directly in the question here. But remember, in IAS 7, they say it's cash and cash equivalents. So that is anything with a maturity of less than 3 months. This short-term investment doesn't have a maturity of less than 3 months, as you'll see in a second, but the overdraft does. So you have 100 of an overdraft, which is minus 100, and then no overdraft in 2014. So you've got a net cash position of 200 in 2013, which is our opening balance, if you wanted to put it in there. That's your opening balance. And your closing balance then is 610. So your 610 cash and cash equivalents at the year end. 200, get the right column there, and 610. Let's just make sure this is all area blue 14. So you have that done straight away now. That's always a good starting point to start with, is what's the answer I'm working towards? So that means you have an increase here, increase of 410. So when we do operating activities plus investing activities plus financing, the net increase should be here 410, and that's what we're working towards. So it's a different way of approaching a question, but you're actually starting with the final answer. Your next step then is to deal with operating activities. Now again, I'm assuming you've paused the question, you've read down through, and you've even attempted it. We have 2 ways of going about operating activity cash flow. Working 2, we're going to do the indirect method. And I'm going to do kind of working 2A over here to show you what the direct method would look like. We'll do the indirect method. This is the one that usually students would take as an approach. I won't mandate whether you have to do one or the other. We'll leave you the choice, but usually the indirect is easier. You always start with profit. We're starting with operating profit here, which is given in the question. Operating profit is 930. Now, of course, you could start with profit after tax, but you're going to be adding back all of those anyway. So the cleanest way is to start with operating profit. We then have a couple of adjustments. We have to do your non-cash adjustments, find those in the question. Then we have to do working capital adjustments. And then you have to come down and take off tax and interest. So tax paid and interest paid. So there is a bit of work in terms of your indirect method, but it's quite repetitive. So if you know it once or twice, it should make it a bit easier. So what we're looking at here then is we've started with profit, we're trying to reconcile the cash flow. First thing we're looking for is what non-cash items are in my profit and loss account that would not be related to cash. You have to strip them out. So if we go down along, we're given information, 2 balance sheets or statement of financial position, and we're given a statement of profit and loss. And you're told in admin expenses, you have a profit on sale of plant 100,000 and a loss on sale of equipment 20,000. So firstly, both of those are accounting entries. What you're not interested for cash flow is the profit or loss in the sale. What you're interested in is how much you actually got in. What money did you get in, the proceeds? And we'll deal with that as a separate working in a second. But a profit on sale here, profit on disposal needs to be removed. So what you do there is you minus 900, or minus 100 should I say. And the loss on disposal, you're going to plus 20. So think of the logic there now is this profit is in the 930. This loss is reducing the 930. You're saying they are non-cash, so you want to remove those, so you're working back towards a cash flow figure. So you always remove non-cash expenses, or you add back non-cash expenses, you remove non-cash income. We then go down along. What else are we told? Depreciation has been charged to distribution costs. So straight away there should be a red flag. I need to figure out what depreciation is to add it back, because that's a non-cash expense and it's in every question. You'll notice here that some questions will tell you what depreciation is. Other questions are set up, you need to solve for what depreciation is. If you know opening accumulated depreciation, you know closing accumulated depreciation, there's only 2 things that change accumulated depreciation during the year. That's the depreciation charge, which we need to figure out, and any possible disposal that might have happened. And we know there were 2 disposals during the year. Right? So that's the next step you have to do. So there are a lot of interlinking workings here. We'll take them piece by piece as we need them, but you may do a couple of things together as you practice more questions. So there is a lot of stuff that you need to practice. It's a different way of approaching question than a normal P&L, balance sheet and statement of changes in equity. So in every question you need to figure out what depreciation is. Sometimes it's given to you because we go with the property, plant and equipment working a different way, but the fact that they've split out cost and accumulated depreciation here means they want you to figure out what it is. So we're actually going to go to working 3 here, because we need to figure out working 3 depreciation. So you see, you will have to kind of do a couple of things simultaneously in cash flow questions to solve things as you go along. And what you're actually going to do here now is you're going to set up a little T account. So T account is important here. Let's tidy up this to make sure it's easy to follow. So let's look at the T account. We're going to set one up for accumulated depreciation. So we'll start from here. Merge and center. Accumulated depreciation, plant. And what's the other one we need? Accumulated depreciation equipment. So we'll start with this one. You underline it. We'll put it down like this here, so it's easy to see what's going on. And we'll pull this. We'll do one over here as well for equipment. Now, some students won't need to open up a T account. They'll be able to solve it quite quickly. For others, it's no harm opening up a T account. We're trying to figure out, we have an opening balance, your balance brought down. On the credit side, your balance brought down for plant, 660. And then you have balance carried down for plant at the end of the year, 860. So that's what it's going to look like in terms of T account, if you remember back. And then over here, you have a balance brought down as well for equipment, which is 620. And you have a balance carried down at the end of the year going forward, which is 660. So remember, accumulated depreciation is a credit balance. That's why the balance is carried down there. Just watch out for that. Make sure you're happy enough what the layout is, at least at the start. We now need to figure out, well, how much depreciation was charged and what impact did the disposal have on that. So we then need to look at part C and D. Take plant first. Plant with a net book value of 600,000, which had originally cost 1 million, was sold during the year. And there's two things going on here. First thing, we can figure out how much accumulated depreciation was. If it cost 1 million and its net book value was 600, its accumulated depreciation must have been 400. So what you're going to do in the plant accumulated depreciation, you're going to say here disposal 400. Because remember what the debits and credits are. It will be debit bank, credit, cost, debit accumulated depreciation. And then you're told the plant made a profit of 100,000, so it's credit SOPL 100. So it's trying to understand all the information that's given. Debits and credits are important here. You mightn't think it is because it's a cash flow, but to solve everything it is. The cost of the machine, or the plant should I say, was 1 million. So you remove the million. I've just dropped the last 3 zeros. And accumulated depreciation, we said, must have been 400,000 because your net book value is 600. So your debit accumulated depreciation 400. So watch the way now, as well as doing accumulated depreciation adjustment, you're actually figuring out how much you sold it for as well. Its net book value was 600. You sold it at a profit of 100. So this must be 700. And that is your disposal proceeds that's going to go into the cash flow. So there are these workings that link together. You get the information for the disposal, but you're also now going to go back up here and say investing activities, disposal of plant, working 3, and you're going to say that was 700. And that's as simple as it is. So it's important just to understand where the figures are coming from as you get something slotted in and cross-reference the working. We figured out there that we disposed of plant, we made a profit, its net book value was 600, so you must have sold it for 700. And what you can also solve for there then is, well, to make this accumulated depreciation work, because you're always assuming these figures are correct in the balance sheet, you're saying, how can I get from 660 to 860 if I've already taken off a disposal during the year? Well, you must have charged depreciation for the year of the balance. So that balance this side must be 1260, has to be the same both sides. So your balance here, 600. And that is in yellow, that's a plug figure. So we know the depreciation charged for plant for 2014 was 600, and you're going to add that back. So there's a different way of looking at these questions, and this should be a revision from your undergrad, but it could have been 2 or 3 years ago since you've done cash flows. So it could be a bit rusty. So we're going to add back there non-cash depreciation, depreciation of plant, working 3, you add back 600. The reason you're adding back is it's a non-cash expense. So that means it shouldn't be reducing to get my cash flow. You take it out. Same logic with equipment. You made a disposal during the year. You're told the equipment here, net book value of 60, originally cost 200. So your accumulated depreciation must have been 140. Which means when you come down along, you must have charged depreciation for the year for equipment. This is the plug figure to make the T account balance, 180. And I always put the plug figure in yellow to show that's a balancing figure. They give you everything bar the depreciation expense, so you need to work that out. In other questions, you'll have to work out something different. They'll give you the depreciation expense directly, but you might have to work out how much the disposal was. So here, depreciation equipment, working 3. And again, you're adding back 180 because it's a non-cash expense. So that just leaves us with the debits and credits. You copy the debits and credits over. And we're trying to figure out how much was in bank. In this case, we know we debited accumulated depreciation 140 because we worked that out at the difference between cost and the net book value. We know we credit cost 200 to get rid of it. And you're told in the question you made a loss of 20. So that must have been debit the P&L 20. So what we're saying here is the net book value was 60. You made a loss of 20. So you must have only sold it for 40. So you're going to say there, you're going to debit bank 40, which will be a cash inflow, disposal of equipment. So same logic for both those non-current assets, but did you know how to approach it? That's where a lot of students fall down. So in our case here, investing activities, disposal of equipment, again, working 3, and that will be plus 40. So you're filling it in as you go, so you're not duplicating your work at the end. So we've done that. We'll come back to working 2 now again. We've got 2 of our non-cash adjustments. Depreciation will always be there. And the only other one, this is a tricky one here, is your share issue expenses. Now, those share issue expenses, 930 over there. If you look at it here, you're told included admin expenses 30,000 paid in the connection of a share issue. The reason we take that out, it's not that it's non-cash, it is a cash expense, but we're going to net that off against the share issue. So instead of putting it into operating cash flows, which would be in here, you're going to take it out and you're going to put it into financing cash flows, netted off against the share proceeds. Because technically the money from the share proceeds should be netted off against the expense of the share proceeds as well. So you're really just being consistent there, but it won't change the overall answer. So there are all your adjustments that you're usually looking for. So you want to add them up, and that's a net adjustment of 730. So your running total now is 1660. And we come down then to our working capital adjustments. So in this case, we have to look at 3. You're looking at moving inventory, moving at trade receivables, moving in trade payables. And these are quite straightforward. You're just trying to figure out, did they increase or decrease, and is that good or bad for cash flow? Now, please note, when you get on to the more advanced consolidated cash flow accounts, this is a bit more complex because you have to account for the fact that any movements in working capital will be influenced by the acquisition or disposal of a sub, and you'll have to strip that out. Here, we're just looking at individual cash flows, so it's much more straightforward. So the inventory, if we look at it here, inventory has gone from 410 down to 370. That's a decrease of 40. A decrease in inventory of 40 is positive for cash flow. It's releasing cash that was tied up in inventory. So you need to look at the movement and then figure out, is it positive or negative cash flow. For receivables, it's gone up by 300. That's a drain on cash flow. An increase in trade receivables is a drain on cash flow. And for trade payables, it's gone down by 100. That's a drain on cash flow as well. So trade receivables and trade payables are the opposite. For trade receivables, an increase is bad because that means there's more money tied up in trade receivables. It's not in cash. And the fact that you have less money owed to suppliers now means you've paid them. So that's a drain on cash flow in the period. So that's the net impact to your working capital, which is 360, and that gets me a running total of 1300. So you're working your way down along each of the key adjustments. You have non-cash adjustments, you have working capital, and then the last 2 you will always have is interest paid, tax paid, and you may have interest received as well. It just depends on the question. So if we come here, what you're always looking for is there any outstanding current liability or current asset related to interest income or interest received. So we'll deal with tax in a second. But we're told in the question, in the P&L, your interest received earned during the year was 108. Now remember, just because it's in the P&L doesn't mean that cash was received. It could be owed at the year end. Same with interest paid. That should really be an interest expense, because you can have an expense incurred, but you may not necessarily pay it yet. So for interest received, we earned 108 during the year. We just want to see, are we owed anything at the year end? And we're not told we're owed anything. So if that's how much you earned and you're owed nothing at the end of the year or the start of the year, you're just going to put in there 108. And you just reference there SOPL. So you're taking it directly from the SOPL because there's no outstanding balances at the year end. The same with interest paid. There's no outstanding balances at the year end. You have no interest accrued. So that means whatever you incurred during the year, the 128, is what you paid. So it would have been credit bank, debit the P&L. There's no accrual at the year end. Tax, however, is slightly differently, and we're going to have to do a working for tax. Because if you look at tax, you had an expense for the year, 70, but in the statement of profit and loss, or statement of financial position, you owed 55 at the start of the year, and you owe 85 at the end of the year. Now, some students will cop that straight away, and they won't need a T account to tell you, but I will just show you what the T account looks like in working for taxation. So you'll take a T account like this, and you're going to say tax liability. We'll just delete those numbers for now. So your opening balance for tax liability we said was 55. Your closing balance was 85. And there's only two things that move it during the year. Your SOPL and bank. So the SOPL, we said you had an extra charge for tax during the year, in this question of 70. So that means if you paid nothing, you should have owed 125 at the end of the year. What you owed at the start of the year, plus the amount of the expense during the year. However, you only owe 85 at the end of the year, so the plug figure must have been credit bank 40. So it's credit bank 40 cash outflow, debit tax liability 40. So you're trying to solve for the tax paid. We didn't have to do that for interest paid because there was no opening or closing interest liability. If there was, you take a similar approach. So you just come up then and tax paid minus 40. And that means overall here, you see what the net impact and your closing net cash flow from operating activities, which you're going to put in there, is 1240. Now that's how you do the indirect method. We'll show you how to do the direct method in a second as well. But that's an important skill you'll have, and that's the first thing you'll do in every question, is you'll do the net cash flow from operating activities. There's a good bit of work there, taking the right profit figure, doing the right adjustments, working capital adjustments, and then interest received, interest paid, and tax paid as well. So just for example, because you're asked, you're going to look at the direct method as well. The direct method is slightly different and it's much shorter, hence the name. You're going to look at cash received from customers, cash paid to suppliers, and other cash expenses. And that's going to get your answer, which is going to hopefully work back to 1300. So this is the place that differs. Tax and interest doesn't change in either method. So we're working to see can we get those three down to 1300 as well. Your cash received from customers is made up of your revenue plus your trade receivable movements. So if we look at, for example, here, and we do a T account for trade receivables. Same as what we've done, trade receivables for the other ones as well. We underline it, and we do it down like this. So here you're going to look at the balance brought down, you're going to look at the balance carried down, and one thing that increases trade receivables is revenue, and then one thing that decreases trade receivables is payments, so money coming into the bank. And that's how you get cash. So you're essentially taking some of the profit figure, the revenue, and adjusting for your trade receivables as well. So trade receivables opening in this case was 290, closing was 590. So 290, 590, and your revenue for the year was 4020. So we're saying if we got paid nothing from our customers, we should be owed 4310 at the end of the year. We're actually only owed 590. So the amount of money received from customers, debit bank, credit trade receivables, is 3.7 million. And that's your first answer you're putting in, 3.7. So it's just a different way of using the same figures to get to the same answer. It's probably less intuitive. That's why most students will use the indirect method if they can. For cash paid to suppliers, we're going to use trade payables instead. So let's do them side by side here. trade payables. So we'll just rearrange that because it's obviously trade payables on the other side. So you here have your balance brought down, balance carried down, you have bank, and then you'll have purchases this side. Just make sure that's the right size. So let's have a look then at your trade payables. So in our case here, your trade payable opening balance was 305, closing balance was 205. There's two things that can move your trade payables: the purchases you make during the year and the money paid to suppliers at the year. So what we're trying to go back and look at now is we're trying to see how can I get purchases. You'll be incorrect if you take cost of sales directly, because that's not really what purchases is. Think about cost of sales. Cost of sales equals opening stock, which we know from the question is 410. We know that's 410. Plus purchases, we know that's going to be X. And minus closing stock, which we know is 370. So your cost of sales here, which is 2060, so don't mind the negative figure, is 410 plus X minus 370. So your purchases here, which is your X, if you work it out, so 2060, bring the 410 across, minus it, bring the 370 across, plus it, is 2021. So that's how we bring in the inventory. The inventory is used, because all the same figures are used, it's used as part of calculating purchases, 2020. So that essentially means that if we didn't pay anything to our trade payables during the year, we should have owed 2325 at the end of the year. We actually only owe 205, so we must have had credited bank, debited trade payables, 2120, which is a cash outflow during the year. Now that is tricky, but you're still using the same figures. You're using the cost of sales from this profit figure. We've used the revenue already. And you're using these three adjustments to try and make it useful. So we're using trade payables, adjustment, and inventory. We've already used trade receivables. So the indirect and the direct methods use the exact same figures in a slightly different way. And the last one, other cash expenses. This is an easier one. You start with the other expenses, which in our case are distribution costs, 816, plus admin expenses, 214. So 1,030,000, these two. And then we've used the revenue, we've used the cost of sales, and we use the expenses, coming back to the 930. So you're using the same figures. So minus 1030, and you make the same adjustments as you would have in the indirect method. So you just add back 730. So you don't need to duplicate it, but you wouldn't be doing two methods in the exam. You do be one or the other. So stick with one, just to make sure there are two that are allowed under IAS 7. And if we do that out, there's your 1300. So the 1300 we got here is the same as the 1300 that we calculate in the indirect method. The tax and interest do not change in either question, so there's no need to worry about that. But that's the biggest working that you'll be doing in statement of cash flows, is getting the net cash flow from operating activities. You're using the same numbers, just in different ways. So we put that in, net cash flow from operating activities, working 1, 1240. So I just put it in as a single line like that. You can show the examiner your workings, but it's just nice and neat then. And there's no ambiguity about where the figures are coming from. So once you have that element done, my advice always is go back to the question, and for each line item now, highlight it once you've explained it. That accumulated depreciation, we've done. So highlight it, that one we've explained. We've done inventories, we've done receivables. Right. So I always just highlight and say they're done. Bank and cash we've done, because that's going to be the answer. We haven't explained any of these yet. We've explained trade payables, we've explained overdraft, we've explained taxation. So it is really like solving a puzzle. That if you can explain every line item, how we went from the opening balance from 2013 accounts to the closing balance 2014, this thing has to balance. And you have to get back to the final answer, which is here, a net increase from 200 to 610 is your 410. That's the answer we're looking for. So you know if you balance each of them and you explain each of them, this should work out. So there's a nice logic to it. So all we're going to do now is take them line by line and explain the rest of them. So plant cost is the first one. So let's come back to our next working here, which is working 5. Plant cost. Now sometimes the examiner will split them and they'll give you plant cost and plant accumulated depreciation separately, like they have here. That's usually given when they want you to figure out what they want you to figure out what depreciation is. In other questions you'll see they'll just give you plant net book value and they'll go at it differently. So you have your balance brought down, you have your balance carried down. So the opening balance in plant was 2060. The closing balance at the end of the year was 2860. So what they're asking you to do is explain how you went from 2 million up to 2.8 million. There's two things that move your plant cost. Your disposal, which we've done about already. So again, did you forget that? So what a lot of students do is they end up forgetting the disposal. We said that credit the cost 1 million. That entry has to be in. We adjusted for the P&L entry. We adjusted for the bank entry. We adjusted for accumulated depreciation here. Then you have to adjust for the cost, which is the million. So you're saying if this side is going to be 3860, both have to balance, both have to be the bigger side. That's how T accounts work. This must be acquisitions. And that must be, in this case, the difference, which is 1.8 million. Now that's important that you understand where those are coming from. Right, so that is an acquisition of property, plant and equipment of 1.8. So that would be debit property, plant and equipment cost, credit bank. So that's yellow because it's a plug figure. You just have a quick look at the balance sheet. There's no money outstanding for property, plant and equipment. So there's no other payables. So you must have paid it all during the year. So you just go in then and slot it in. Here, acquisition plant, W5, and you put there minus 1800 because that is a cash outflow. I'll just tidy up that to make sure it's all the same as the rest of them. So that's one. So see, can you do that now for your equipment as well? Exact same logic. We've explained the plant. Now let's explain the equipment. Very similar working. This is going to be working 6. So the equipment cost here now. Opening balance of equipment was 1140. Delete that. Your disposal, we said, of equipment was 200. Make sure you're putting in the cost now, because this is the cost T account. And your closing balance was 1260. So you're trying to figure out both sides should be 1460. It clearly doesn't balance. You're short on the debit side, so there must have been an acquisition during the year. Like that note E told you, all non-current asset additions were paid for in cash. So we must say the balancing figure there must be acquisition of 320. So that would have been debit equipment cost 320, credit bank 320. And if it's a credit to the bank, it's a cash outflow. So you just say there, equipment acquisition, working 6 minus 320. All right, that's all you need to show for that to get your marks. So you're slotting them in as you go along, and you're reducing the risk that you run out of time at the end of the exam question. So again, just get the discipline in, and once you have those done, like I've just highlighted them, you can tick them off, but make sure if you've explained each of them, the whole thing should balance. Short-term investments, we've come down and we said there's a note here. These are included in current assets related to a 9-month deposit that matures on the 1st of February, and you can't withdraw it without losing all your interest. Now, the key thing is here, this is the 31st of December. So technically in a month's time, this investment matures. And the criteria for cash equivalents in IS7 is less than 3 months. Now, it's not 3 months from the year end. It's the overall maturity deposit length of the investment. Here, this is a 9-month deposit. It doesn't matter when it ends. This would not be classified as cash and cash equivalents. If it was, you would put it into this working here and it would be finished. It would be part of the answer that you'd be getting, like the overdraft. But because it isn't, you treat it as any other asset. Essentially what's happened here is, during the year, they've bought investments worth $1 million. So that would have been debit investments, current assets, credit bank. So this is actually a cash outflow. From here to here, you've invested in assets, which must have meant you've an outflow of cash. So all you put there is investing activities, short-term investments, and I'll just put there from the SOFP to show the examiner where it's coming from, and that will be minus $1 million. So that's important that you understand where they're coming from. Think about the debits and credits. If you buy assets during the year, that's an outflow of cash. So we can tick that off. And that is why the short-term investment is not in cash equivalents, because it's the total length of the term, not just the amount of the term that's left at the year end. Share capital and share premium. There's clearly been a share issue during the year. You always do these together. So what you're saying here is there's been a share issue of 400,000. 300 increase in capital, 100 increase in the premium. These are financing activities, share issue. Be careful now, net of expenses. So remember what we did. This is going to be 400 minus 30. So the reason it's 400 minus 30 is, we said in our working 2, we added back the share issue expenses of 30. That was per note B, because we said, look, they are an expense, they are a cash outflow, but they should really be just netted off against the financing activities. So you're matching the expense with the inflow of cash as well. That's another one done, and you always do both of those together because it doesn't make sense to look at them separately. Retained earnings. This is a tricky one because sometimes you're not told if there's dividends paid or not. They tell you here that there were dividends. Be careful now, it wasn't dividends paid, there were dividends debited to equity. That's the important word here. And to be honest, you don't need to be told that. In part G, you should be able to solve here. Your retained earnings are going from 450 up to 1250. So if we come down here and do working 7, dividends, we can prove where that's coming from. Let's just show you this as an example. So retained earnings, right? There's only 2 things that move retained earnings. So remember that from any exam question, any your prior studies, you're going from 450 up to here 1250. So there's only 2 things that will move your dividends. That is your profit for the year, which we know in the question is 840. So that means if we didn't pay any dividends, we should have had 1290 in retained earnings. So your opening retained earnings plus your profit after tax for the year. We only have 1250, which are told in the question. So that must have meant there was dividends debited to equity. Now that's important, the wording of it. It means it would have been debit retained earnings, but it wasn't credit dividends or credit bank. It was credit dividends payable, because you actually have a dividend payable here. If that wasn't there, it'd be just credit bank and the 40 is an outflow. But because you have a dividend payable, you actually have to go on and do one other working. Div payable. Your opening dividend payable here is 10. Your closing dividend payable is 30. And you created dividends during the year of 40. Right. It's important to understand where these figures are coming from. So you're saying we did kind of this, like we declared dividends of 40 during the year. We owed 10 at the start. So that means if we paid no dividends out of bank, we should have owed 50. We actually only owe 30 at the end of the year, so we must have paid 20 out of bank. And that's what we're interested in the cash flow statement. So it must have been credit bank 20, cash outflow, debit dividend payable 20. So it's important to try and link those things together, otherwise you're going to make a mistake. So that would be in the financing section as well. Dividend paid, working 7, and that's a minus 20. And that's another one complete. So you're just ticking them off as you go along. That explained retained earnings, and that explained dividends. So the only thing we're interested in to finish it off, and hopefully that balances it up, is the 1.2 million in debentures. Now again, be careful. Similar to short-term investments, what would the debit and credit be here? We've taken on a new loan over the last year, over 2014. That would have been debit bank, because when you take on a loan, you get the money in, and it would have been credit the loan. So when you draw down a loan like here, that's a cash inflow. When you pay down a loan, which is the opposite, that'd be a cash outflow. So we call that a loan drawdown from the SOFP plus 1200. Now, if we're doing our job correctly, when we tot up these, so you see that we have subtotals, that's the net cash flow from investing activities. It's an outflow. That's the net cash flow from financing activities. It's an inflow. And when we add those three together, because we've ticked off every item there, we've explained it, that means, hopefully you can see here, if I add those three, it gets me to 410. So I know I'm correct because that reconciles the answer I've done at the very first working. So that's why it's useful to have that working done to know what you're working back towards. So similar like when you know your balance sheet doesn't balance, you can try and identify where the issues are. So it's a big thing there about practicing statement of cash flow questions, particularly the approach. First step is to lay out a template and have space for each of the line items. Second thing is to calculate your answer. And third thing then is your statement or your operating cash flows, which usually we use the indirect method. There is a direct method. You won't be explicitly asked for it because that wouldn't be fair. You can do either or. Most students will do this one because it's a bit more straightforward to approach. Right? So make sure you have a look at that now. That's question 2. And there's another nice question 1 called Ben Limited, which is a similar standard. But you need to understand the individual statement of cash flows and go back and look at your undergrad material if you want, because this is assumed knowledge. And then we'll move on to bringing in subsidiaries, bringing in associates, bringing in NCIs. And it's only a small step up. It's an extra working for each of them to do a consolidated statement of cash flows.